Okay, right. So we are recording. Let me share my screen. Let's get back to our slide. Okay. Mm-mm. Right. So we were on periodic and perpetual. Somebody tell me, what is this all about? What is this all about? Periodic and perpetual, or perpetual or periodic. Why is this all about? Yes. Yeah. 100%. This is in relation to your inventory system. How do you update your or manage your inventory system? Okay. Um, so this is nothing new to you guys. All right. I'm sure it's more of a recap than anything, but I know in counting one, you guys actually discussed in unit six um, inventory systems. Okay. So as you know, we have the perpetual and we have the periodic inventory system. Which one do we like more? Perpetual. Why do we like the perpetual more than the periodic? 100%. Did you guys hear that? All right. The reason why we like the perpetual is because we are consistently updating how much inventory we have. Okay. Whereas with the periodic, we are only checking how much inventory we have at the end of the financial period. Okay. So in other words, we could check at the end of the month, or we could check at the end of the financial year. Does that make sense? Now, because we're consistently aware of how much inventory we have under the perpetual, right? At any given point in time, we can also calculate our cost of sales. And if we can calculate our cost of sales, that means that at any given point in time, we can calculate or determine our gross margin. In other words, that's just another word for our gross profit. Okay? So you see, under the periodic, we can only calculate our gross profit once we know our cost of sales. Okay? And therefore, we have to then do a separate calculation under the periodic to actually find out our cost of sales and then determine the gross profit. All right? So that's why we also like the perpetual inventory system. All right? Now, an example of the perpetual inventory system, right? I think by now you guys have realized I like to talk about grocery stores. Okay? But any company, even if you go to your Total Sport or your Nike stores, any store, game, anywhere where they have a scanner, right? Whenever you purchase a product, right? And you scan that product, that is actually the perpetual inventory system up there. Because on that computer system, it is sending something to software. It is sending a message to the software that they use, right? For this perpetual inventory system that is letting them know we just sold a bicycle. Okay. Therefore, we only have 8 bicycles left. And via that very same system, you then can know, okay, when we get to 5 bicycles in the store, we need to then order another 5 from our manufacturer. Okay? So it's such an advantageous system, all right, for stock management. Okay, all right? It also allows us to know we're supposed to have 5 bicycles, all right, based on our system. We looked and we logged in and we saw, okay, cool. We sold 5, we had 10 at the beginning of the month, we only have 5 according to our system. So when we go into the storage, how many bicycles should we find? If our system is telling us we have 5 remaining, how many should we find when we go into the storage? That's 5. If we don't have 5 in the storage, what does that tell us? Hmm? Trinkets, yes, trinkets. Something was stolen, maybe it wasn't delivered, right? Something happened. We know that something happened, right? And therefore, what do we need to do? We need to investigate what may have happened. We need to ensure that it doesn't happen again. And also, what does it tell us? Oh, also, in addition to that, we now need to incorporate that loss via cost of sales. We need to account for that loss bicycle. Does that make sense? So that's all the perpetual inventory system does for us. Now, under the periodic, when we move slides, so these are things we all spoke about. All right, we spoke about this, but I'm going to pass the slides here for a minute. Now, under the periodic inventory system, we bought 10 bicycles, but we don't know how many we've actually sold because we're not continuously accounting for that. The only time we actually account for how much stock we have is when we go and check in the storage. Does that make sense? So we could get to the storage and we realize we only have 3 bicycles. Okay? Now because we weren't actually continuously updating how many we have, all right? Now if we go look at our books, maybe we sold 5. Okay? That would be the only way we can say, okay, is there a shortage in terms of what we have and what we should have. Okay? That's the only way we could potentially um, measure. But think about it, if you're in a grocery store, you've got so many things, so many tomatoes, so many this, that, and the third. Under periodic system, it really would not be an efficient way to manage your inventory because it's now hard for you to keep on the ball, keep track of did this thing get stolen, did this thing become obsolete or go rotten, right? Will it get damaged upon delivery? Was this thing even delivered in the first place? Does it make sense? So we really would like to, as a business, operate under the perpetual. But for some businesses, such as a spaza shop, it doesn't make sense to invest so much into software systems and you know when obviously your business is not turning that much money per se. Okay. Also, if you look at some businesses, it's hard for stock to just go missing, so you don't necessarily have to be operating under the second business. So I'm using an example, such as a car dealership, and those of you who may have been with me last year, you might recall me using that as an example. Cars are never going to disappear off the cliff. Okay? We only have 5 cars of this make or this model. It's not just going to disappear. So we don't necessarily have to use the first. It would make our lives easier because this is all happening in the background without any assistance from us, but it's not a must. Okay. Now here, this is just a recap. I don't know if this is in your text. I can't really recall. But this is the formula for calculating cost of sales under the periodic industry system. Okay. It's very easy to remember. You don't have to cram it. Okay. Hopefully by now you already do know. Okay. Opening inventory. How much stock did I have at the beginning of the financial period or at the beginning of the month? That's opening inventory. What do I have on hand? That's what you're opening the financial period with, what you started with. Okay? Right. Then you go on to say, did I purchase anything during the course of the month? All right, or during the course of the financial period. All right? Did I purchase anything? So start with what did you have? Did I purchase anything? Okay. Did I return any purchases returned? All right, let's purchases returned. That's what we're saying here. If we didn't return anything, there won't be any purchases returned. Does that make sense? Okay. Then we say, did we incur any additional costs in relation to our inventory or in relation to getting our inventory onto the shelf during the course of this financial period? Was there any expense? Was there any carriage inwards? Was there any, what do you call it? Drainage? All right? Import tariff, customs duty, all of that. These are just additional costs that we incur to bring our inventory to the shelf. Okay? And then finally, what did we close off with at the end of the month? What did we remain with in terms of inventory? We need to subtract that. Because obviously, if we remain with it, what that's telling us is that we didn't sell it. Does that make sense? When we're calculating cost of sales, we're saying, what was the cost of the inventory that we have sold, that was left? That's right, cost of, what does it tell me? Cost of, does it make sense now? And that's why I'm saying you don't need to plan this, you just need to understand it. Okay? Understand it, and you can save the planning for something more important, all right, or more challenging. Okay, cool. Any questions or thoughts thus far? Is everybody happy? Is everybody happy? Yes. Also activities to a profit. Yes, 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 yes. It would be considered losses. What do you call it? Something else. Well, we just posted to the cost of sales account. We just posted to the cost of sales account. I'm not just trying to remember what the thing is, but it may be in your section, it may be on this slide. Okay, so here in the last paragraph it says, therefore the balance continues to account reflects the best case scenario. However, if there are any discrepancies or losses, okay, in stock, the trading inventory account will be credited. Remember, the trading inventory account is not asset account. So the increase on the debit side, increase on the credit side. So if we're crediting it, it's because of its decreasing. What have we lost? We've lost stock. We've lost inventory. Okay? So that's why we're crediting the trading inventory account. And then what do we do? Cost of sales account is debit. So again, they're not executing the right line. And that's how we do it. I think in your trading inventory account, you're going to write cost of sales on the credit side. In your cost of sales account, you're going to write trading inventory. Thank you for that. Thank you for that. The teacher also needed that recap. Okay, awesome. Right. Now, we're getting to closer and closer to the numbers. Analysis and interpretation of financial statements. So all of the information, and I spoke to this in the first brief. All of our figures and information that we have in our financial statements and also with the ratios, which you will see a lot of that now. We don't just look at the numbers and say, wow, okay, we made a profit. Happy. No, we say, how much profit did you make last year? Did you make more or less than what you made last year? All right? And why? Okay? And why? Okay? So it's the same thing with ratios. Ratios, we look at it and we say, did you perform better or worse than you did? All right? And then we also say, in relation to our competitors, all right, how have we performed in relation to our competitors? Okay? Industry average, how have we performed? Are we doing better than the industry average or are we doing worse? Okay. All of this is about comparison. All right. Why do we compare? Because that gives us, as you can see in purple, perspective. Perspective. All right. If you are all to run in a race, not everybody's going to get a gold medal. All right. Right? There's some are going to be better than others. All right. How do we see who has done better than others? By finding out who came first, second, and third. Okay. All right. Comparison. All right. Here they're just talking to ratios, and they're saying ratios are used by stakeholders to determine the position or potential of the company in which they are interested. Okay. Now they speak to the solvency ratio. Okay. And what are we measuring with the solvency ratio? Solvency ratio, we're literally saying, can this company cover its liability? All right. If it's to sell all its assets, will they cover the liability? If the assets are less than then the company. Sorry, if the assets, I said the assets are less than the assets. My apologies. And then say if the assets are less than the liabilities, that means that the company is insolvent. Okay. It cannot cover its total liability. However, if it's the other way around, if its assets are greater than, you see this in the underlying, assets are greater than the liability, the business is solvent. It can splash that cash and cover its liability, which is a good thing. All right, that's what we want. Okay, now here we start to jump into the ratios. Now you have types of ratios. Right? And the first set of types of ratios that we have is profitability. Profitability ratio, we have the gross profit percentage. Gross profit percentage. Now, guys, now that we are starting to get into the numbers, yeah? This is what you guys need to do. You need to develop a formula sheet. And on that formula sheet, as you go through each unit, you need to update that formula sheet. Remember what I said? We're just going through the theory so that we can do the number problem. Okay? So literally, as soon as we're done with this lecture, and we will start to get into the numbers. Okay, going through exercise, going through examples together. Okay. But if you don't understand what you're actually calculating or what exactly is going on, you might know the formula, but when we now make you apply, that's when things will start to get a bit shaky. And how do I know this? Because I've seen students actually put down the right formula. But now when we now ask them to calculate gross profit percentage, things get a bit dicey. Okay? So please just take the time to make sure you understand, and this time here, you can ask me if there's anything that's not exactly making sense, and then obviously you can text me. Okay. So profitability, we're saying, okay, gross profit percentage. Okay. How do you calculate it? Gross profit divided by total sales. What are we saying there? What portion of our total sales can we attribute to gross profit? How much of our total sales do we still retain after having deducted our cost of sales? Put it another way. Does it make sense? All right. It shows us, okay, are our cost of sales really high? For instance, if we have 15% on gross profit percentage after, if we have 15% gross profit percentage, it means 85% of that has been charged by cost of sales, which I think in any business is not your business. Okay? All right? Because obviously you still have other expenses, such as rent, such as salaries and wages. All right? Other things that you need to take into marketing. Okay? So chances are that's not a very ideal situation to be in. Unless you're operating with very high figures and you start that really. given to the non-ideal situation. Then net profit percentage. How much of our net profit is how much of our net profit do we get from our total sales? So what portion of our total sales belongs to our net profit? Does it make sense? Okay, as a percentage. All right. Again, you must know: is this thing supposed to be a percentage? Is it supposed to be in days, or is it supposed to be a ratio? Okay. Then return on average owner's equity. Sometimes, guys, you might not necessarily need to cram. You guys shouldn't be using the word cram, but maybe you shouldn't need to study all of these formulas. Some of them, once you know gross profit percentage, okay, we're saying what portion of our gross profit, what portion of our sales is gross profit? Sorry, what portion of our total sales is gross profit? Okay. When you now understand that, that is obviously okay. Gross profit divided by total sales. That's how you can begin to market something. You don't necessarily make sure that looking at them instead of every single day. Okay. Return on average owner's equity. We know that net profit is the return. Profit is the return that we give to shareholders or people who own the business. So you're saying, okay, net profit has to be involved in this formula. Then divided by the average equity that each shareholder has. What is the average owner's equity? Okay. How many owners do we have? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. 11 owners. How much equity do we have in the business? Divide that by the 11. Then we have our own average owner's equity. Net profit divided by the average owner's equity, boom. We have our answer. Okay? You have to understand those things because whenever you have a mathematical thing, we're going to give you just enough information to calculate or do what you need to do. We're not going to give it to you on a single platform. That's why I said online, understand, master, and apply. Okay? Right. So here, what are we now looking at? We're now looking at liquidity ratios. What are liquidity ratios typically looking at? How liquid is the business? When we talk about liquidity, we're talking about cash. Is there cash in the business? Why is liquidity important? Somebody tell me. Why is liquidity important? Why is having cash in the business? What do you want cash for? Yeah. Take care of yourself, everyone else. What? So we need cash in the business in order to operate. Okay, for the very reasons they both said. Okay. So when looking at a business as an investor, right, maybe you're not necessarily the financial manager of this business. As an investor, you're looking on the outside, looking in, and saying, "Is this a good business? Is it liquid? Is it able to pay its salaries? Is it able to pay its credit?" Okay. Then you fill out the ratio. So you want to say something. And to provide for credit loss, make a provision for credit loss. So the first liquidity ratio, we have the current ratio. What's the current ratio? Current ratio. Think current. Current. What two current things do we have? We have current assets and we have current liabilities. We are comparing these two. Okay? We're comparing these two. And typically you want your assets to be more than your current liabilities. What is it saying? It's saying that if I sell off all my current assets, I'll be able to cover my current liabilities. Does it make sense? So your current assets, what are the current assets that you have in the business? There's obviously inventory. Let me take that one off the table right away before somebody else says it. What else do you have? What are the current assets do you have? Who are the people that owe us? What are they called? Debtors. That's another current asset. What else? Okay. So can you see? Finances, assuming you already have this knowledge. You already know what your current assets are. What other current assets do you have? What is that? What am I referring to? Cash. Cash is also another current asset. All right. Um, so, guys, do you think that you guys know something? No. Okay. Right. So, when we now go to the asset test ratio, we're saying, okay, this is which, which is under the current ratio. Okay. But let's take it a step further and see if we remove inventory from our current assets, is this business still capable of covering its current liability? Okay. Now, obviously, if it's still, if this number is greater than one, right? In other words, if the current assets are still greater than the current liability, that's a very, very good sign. Okay? A very, very good sign. So basically what they're saying, why are we removing trading inventory specifically? We're removing trading inventory because they're saying the very product that you use to actually generate income, if you remove that from the trade, are you still able to pay your current liabilities? And typically your current liabilities would be a bank overdraft, would be, and these are bank overdraft that obviously you pay within 12 months. Also would be creditors, all right, your suppliers that have allowed you to take goods out of credit. So things to that effect. Maybe you took out a small loan, all right. So that's a brilliant sign. Then what we have is the average versus collection period. So you see by virtue of that actual name, average versus collection period. We're not calculating a percentage, we're not calculating a rate, we're calculating a period, time frame. Therefore, we need to be days. I don't know how many sticks are marked with percentages. And sometimes you are calculating the right thing, but it isn't percentage. Time percentage. I don't know whether good per month or good or message month or what. Okay? And what it shows me is that the students actually went to these exams. They actually went and learned for me. But they didn't understand what they were right? So, understanding what they were. How do you calculate it? Average trade debtors. Now, typically, they give you 2020 debtors, right? The amount, how much was owed, then they'll give you 2021. To get the average, what do you do? You've got two periods here, last year's debtors and this year's debtors. How do you get the average? You, you subtract. Add them and divide it by 2. What if they gave us 2019? You're 100% right. We add those two and then divide it by 2. What if they also gave us 2019? What do we do? Add the 3 and divide by 3. So what am I teaching you here? Let me give you 5. Add the 5 and divide by 5. That's our application. You get what I'm saying? Now that you now have the average trade, that is now what we need to calculate is that divided by the credit sales. Okay? Divided by the credit sales and then you times by 20. And that what does that actually tell you? It tells you that, let's say the answer is 20 days. It tells you that on average, our debtors pay us what they owe us in 20 days. Does that make sense? So that's why that information is important. Because as an investor, if I look at this business and they get this money on average in 60 days, when the industry average is 30 days, then I'm looking at that. It's a bad thing because you should be getting the money a lot faster. All right. So somewhere in this, there is not but the collective process is not as efficient as it should. Maybe he's picking up people who he shouldn't be giving um, credit to. Okay. Because not everybody should be given access to or allowed to take out our goods and credit. Okay? Now, when it comes to the average credit collection period, this is the exact opposite of the average debit collection. Somebody can have the level moving from debit to credit. What do we actually assess? Yeah. Uh-huh. So what does that mean? What does that mean? Ah, understood. I see. Now, you start to really just understand that if you understood the debtors, collection period is easy for debtor, creditors. It's only now the roles have been reversed. First we were looking at people who owe us. Now we're looking at how long does it take us to pay those bills. Alright? That's it. And as an investor, what does that tell me? Does this business honor its they pay on time? Do they have a good relationship with it? If I'm paying my supplier on time, obviously we're going to have it. And obviously we're going to be open to giving you more credit or discussing good terms for you as a business because they know I'm going to pay. Okay. Right? And then finally, so literally it's the exact same process, exact same thing. The only thing is you're looking at it now, you want the average creditors amount and obviously your credit purchases instead of your credit sales. That's the exact same calculation. And then your average inventory turnover. This is what we were speaking about earlier when I was saying that if you don't understand what turnover, inventory turnover is, it's going to be, you're not going to know what you're actually doing here. All right? And we said inventory turnover is the number of times, okay, we actually manage to sell all our stock. Okay. So if we then take our cost of sales and we divide it by the average inventory, remember once again, average inventory, we're saying 2020, what is our average inventory? What is our inventory? 2021, what is our inventory? Add it together, divide, get our average. Then we take our cost of sales for this period and then we divide it by the average inventory and we get the number of times. Now, if that is 5 times, it means that we turn over all our stock 5 times this year. Does it make sense? Okay. So it's a very important thing. Why? Because once again, we could compare it to say, if last year our the answer to that was 10 times, and this year it's only 5, what does that tell us? If last year we managed to do 10 times, this year we only managed to do 5 times. 5 times our inventory turnover, average inventory turnover. What does that tell us? Sales that they decrease. We're selling less. So if this business is selling less, all right, are you going to buy into my business? Unless it's unless it's a around. But also there's certain things that you can do like I'm not actually selling because obviously right now we are not performing the way we used to. The next approach, even as it is distributing on the best. But I understand. Good stuff, good stuff. All right, cool. Let's move on. Okay, then investing in shares. All right. All right, all right, all right. Interesting time. Okay, purchasing equity. Yeah, so these are things you can obviously read in your books. Equity is obviously, like I said, it's ownership. So when you purchase a share on the JSC, you are purchasing some ownership in that particular business. So when you purchase shares and stuff. You can buy on the primary market. So this is the first time a company goes on an IPO. IPO, initial, initial public offering. Somebody just Google that quickly for me. IPO, what it stands for? Initial public offering, I believe it is. Just want to verify. When a company goes, I don't know if you guys have watched Wolf of Wall Street. Hands up who watched Wolf of Wall Street. Okay, cool. There are other investment movies, but when those guys brought the company to an IPO, it was the first time that that company, people in the public, the general people, could then purchase into that business, buy shares into that business. So that's what an IPO is. Anybody gotten the what they mean? Initial public offering. Okay. So that's the primary market when you're buying shares into this business for the first time. All right. Then secondary market. This thing is now available on the days. Any given point in time, you can buy into India, you can buy into Vodafone. All right. You can buy into Apple. You can buy into Google via the New York Stock Exchange. All right. Those guys have already had their IPO. They are on the secondary market. You can also sell back your shares if you want to on the secondary market. Yes. I don't need it. Yes, even in South Africa. They are alternatives. Sorry? Yeah, it's just more popular. Even same thing with other bond exchanges. It's not as popular. Yeah. Same thing in Europe or in America. With different exchanges. But I don't know why that is the case. But hold on. Unit chart. Unit chart is basically it's, it's, the reality is that so for instance, if you look at the share price of Apple, it's actually quite expensive. All right. The most expensive technology stock last I checked for her. Most expensive technology stock last I heard. It might be quite expensive for us to buy one share of Apple, right? Because maybe we just don't have the budget. Okay? So what do we do? We say, okay, we want to buy an Apple, but we obviously can't afford it in and of ourselves. So we then say, let's create a unit, put our money together. And then when we put our money together, then we can go and buy. Okay? And that makes sense. So that's the purpose of the unit. That's literally you're doing the very same thing. You're buying into it. Buy a unit trust. Okay? I think some of you might even have unit trusts. Because you can get this through the banks and certain houses and things. Okay, let's move on. There's two types of analysis when it comes to purchasing. When it comes to purchasing shares or investing in shares in stocks and stuff. You've got technical analysis. Now, in technical analysis, literally all that you're doing is you're looking for patterns. Right? You're looking for patterns in the economy, in stocks, etc. etc. So when you see that there's a recurring pattern, it will influence now your investment decisions. So for example, if I see how does the economy behave whenever there's a recession? Okay, people stop buying. This is just an example. People stop buying stocks because they have less disposable income. So what do I do? When I see that, as a result of people selling their shares because now they're just trying to get whatever money they have, I wait for them to sell. Because if everybody is selling, that means that the price is going to decrease for the stock. This is not relevant business, I'm just trying to give you contextual understanding technical analysis. As the price is decreasing, then what do? I wait for the price to keep going down and then I buy. Can you see how looking at all those charts and patterns has influenced my investment decision? Okay? And if the opposite were happening, I would be saying, okay, this price is about to increase because now the economy is doing great and everybody's excited and everybody's buying into whatever company, TikTok, for example, maybe, you know. I buy early because I've seen the trend. I saw how things happen with Facebook. I saw how things happen with Twitter. I saw how things happen with Instagram. And I'm like, TikTok is the next big thing. Let me buy into it. I buy my shares and I wait for the rest of the market. And then just like it rises. So that's technical analysis. Looking at all the patterns and seeing okay, what is likely to happen. Okay, as a result of that. So trends are your friend when it comes to technical analysis. Okay. All right, cool. So do read that information. It's relevant. It's also going to give you more perspective and understanding of what technical analysis is. Okay. Yeah. Okay. Now, the other thing that we have is fundamental analysis. And here, what's happening with fundamental analysis? Here, we're literally saying, okay, what are the fundamentals? How is the economy doing? Okay, the economy is doing pretty well. Okay. How is that particular mining industry, so we're saying to you guys, how is the mining industry doing? The mining industry is doing well. Why? Because the rand is low or in comparison to other currencies. So there's a lot of external parties, so there's a lot of exports from our minerals because it's cheaper for them to buy from us. If the rand strengthens, then the mining industry won't do as well because it becomes more expensive for people to actually buy our minerals to get their money and get their funds for our stuff. Okay, so and then we look at the particular business. So it's three steps. You're looking at the industry, you look at the business, you look at the industry, and you look at the economy. All right? And based on those things, then you then decide. Right? I'm trying to give an example of something that may not be doing too well. Insurance is not doing well. Why is insurance not doing well in our current economic climate? Because people have less money to pay their premiums. But at the same time, there's a lot more claims that are going on. For instance, there's insurance for salaries. So if you've lost your job, you can maintain that insurance. If you've gotten sick, medical aid is obviously on the claim, right? So there's all these claims going on, and they might not necessarily be receiving the income that they were receiving before. So that obviously helps them. So you see, the economy is not doing well, the industry is not doing well. So therefore, would it be wise for us to buy into a liberty like that? It doesn't make sense to buy into that company. You get what I'm saying? So we analyze all of that. Okay, so that's fundamental analysis. A lot of people actually like fundamental analysis more because when you're just looking at trends, it's gambling to an extent. Yes, it's also educated you know, method of building stuff. There's no guarantee that that pattern is going to happen as it happened in the past. Does that make sense? So yes, while you've done your research, you look at several different scenarios that are quite similar to the situation that's about to arise or is in effect. But you can't say for sure that's exactly what's going to happen. Okay. So I've spoken to fundamental analysis. Okay. Right. We've spoken about profitability. We've spoken about liquidity, gearing ratios. We measure the extent to which the business is leveraged. In other words, how much debt is in the business. Okay. Then we're going to touch on investment ratios before we wrap up. Okay. So just quickly on gearing ratios, the more debt you have in the business, the more risky it is. Okay. The more leveraged you are, when you have more debt in it. Does that make sense? So whenever they say that business is highly leveraged, somebody may listen to things like the money cost, the money short. I know. This anybody else? Anybody else? Um, show your hand. But the only point that I'm trying to highlight is whenever you hear people, maybe you see it in the movie, they say, that business is highly leveraged or they finance that through highly leveraged. What they're saying is that a lot of people finance through debt, and the higher the leveraging, the more risk you take on. Why? Because there's no guarantee that next month you will have an income. In any business, there's risk. Nobody can guarantee that we are definitely going to keep making what we're making. Even Coca-Cola can never tell you that 15, 20, 30 years from now, we will still be as profitable as we are. Okay? So, yeah, those are things that you obviously want to want to want to be aware of as an investor, kind of how they right. So here you've got two gearing ratios, non-current assets, non-current liabilities, and then there's also equity. Remember, equity is how much money the investors or the owners of the business have put into the business, okay, compared to the non-current liability. All right. And then here you have the total gearing ratio, long-term liabilities. Okay. Capital employed is different from total equity. What's the difference between capital employed and Total equity. Under the family. You all know what total equity is. How much you guys are putting into the business by your own money or assets, right? That's total equity. What is total capital? What? Or what can do? Yeah. So total equity is how much you guys have put into the business. Like I said again, via assets or via your own money. Now, total capital, as we highlighted, is that plus whatever financing we took from FNB, ABSA, NetBank, etc. Does that make sense? Total capital, everything that we have actually put towards capital, okay, divided by our long-term, in other words, our non-current liability. Okay, because we want to see how much of our capital that we had in this business is actually from other financial institutions or from debt. That's what we are measuring here. That's why it's a total business. Okay? Then it says calculate borrowing capital to total capital employed. Borrowing capital to total capital employed for the business and we use to assess financial risk. Remember what I said? The more we borrow, the more we are using. Total capital employed equals equity plus long-term liability. So it's actually on the board that I'm asking. Okay? Cool. Right. Now, now they're speaking to investment ratios. Okay. Guys, a lot of this will fly over your heads because you need to see this in the first time. So, I think that's really good. But I want to just say something quickly in relation to the deal with. I think I've explained quite a bit in terms of this, but I want you guys to see. We have two businesses. We're gonna call this business what's the name of the business? Yeah? Anywhere in the travel, anywhere in so we have two guys that are right? Now let's look at see. The both two businesses I'm going to tell you, both of them are connected businesses that we have. They have this business, all of them. Right? Now, one business is highly risk. In other words, we have finance, less than these guys are making the exact same turnover, they have the exact same expenses. Those are slightly higher because we have, remember that, external finance. If you have on a monthly basis, you pay those installments for the money to borrow, right? Okay. Now, if both you do is you're making 100,000 every month, okay, in terms of sales. Now, because of the value coming in, it is going to be trying to make up for both of their sales, 50,000 a month. This business is more. Remember, she has almost those are not going to go away because they're high. And that's why we say there's more risk when you live so can you see now practically what is more risk in that business? I hope it makes more sense. Cool. Let's wrap this up. Okay. All right. So, guys, go through this in your own time. Earnings per share. We're basically saying how much am I earning per share of this company that I just bought into? It's divided by earnings, in other words, the profit that's available to ordinary shareholders. Earnings attributed it's the profit that's attributed. So we can make 100,000 in profit, but we will say we're only going to give 30,000 to our shareholders. Okay? That 30,000 is what's going to be good, not 100,000. 30,000. And then we say how many ordinary shareholders do we have? and then you can calculate your earnings per share. Yeah. So we are just talking more into that. Why is this important to us? Because remember, as investors or owners of a business, we want a return on our investment. So this is why companies that don't pay a dividend, don't give us a return, are not as favorable as companies that do give us a return. Why? Because we want money. We want something for the money we put in the business. Okay? So the higher the earnings per share, the more attractive the business. Okay? So when you're looking at these ratios and deciding which business to invest in, you'll be more inclined to invest in a business that has a higher earnings per share. Okay. Right. Then the next one that you have is your PE ratio, price earnings ratio. Okay, here we're saying price, think price. What is the price of this share? 10 rand. Okay. What do I earn per share? Okay. Now basically here, what we want is for it to be as low as possible. All right? Measures investors' confidence in the company, the relationship indicates how much investors are willing to pay for each rand of a particular company. Okay? The lower a firm's PE ratio, the cheaper the share is relative to its current earnings. Okay? A high PE ratio can be one of two things. The share is expensive, then the share is highly rated. Okay? We don't want this PE ratio to be high. Because what we want is, remember, in life, we're always looking for a value. The less I can pay for a bigger return, the better. Does that make sense? So if the price is cheap, but I get a good return, so I'm paying less but getting more. That's what we want from the high. If it's high, this is why they explain if you have a high ratio, the share is expensive, one, and it's considered highly rated. All right? Like, why would something be highly rated, you may ask? Something may be highly rated because who believes Apple is about to disappear? Like, do you believe that it's about to crash? Right? We think that it's around the very So, as such, we wouldn't mind investing in that because we believe that our money is not going to disappear overnight. Okay? So it's highly rated. So here, let me talk about if I do these things, try to understand these things, understand what's actually happening, what are we actually measuring. The more you understand that, easier to be in test one. Remember test one, these are the things that happen. Alright? And these are the number crunching things that you're going to be doing. Right? So make sure that you get into test one, because then when you understand it, you understand it, and then it will be easier with listening. Then dividend yield. Here we're just saying what is the return on what we paid? So they might give us a 10 rand dividend, and the cost for each share was 100 rand. So our dividend yield is 10%. What does that mean? I have had a 10% return on the 100 rand that I paid. Does that make sense? So when you think dividend yield, just think how much did I pay for the share? How much am I getting in return for the share? All right. Dividend yield. Okay. Right. Then dividend payout ratio. Okay, so here it's your dividend per share. Now, if they give you something like this, it's so easy to see who really put in the effort and time. Because one, in order to actually do this, you need to know how to calculate earnings per share. Okay? First, you have to obviously get the formula right, but then you have to be able to calculate earnings. And how do you calculate earnings per share? Can you tell me what are you calculating when you do earnings per share? How are you calculating? Think what is earnings per share? Earnings per share. So how do you calculate it? keep you here for the whole. I've already gone past my time. Remember, the profit that has been attributed to ordinary shareholders divided by the number of shares allocated to ordinary shareholders. That's earnings. How much earnings are allocated to these guys? And then the number of shares. You get that? Earnings for each share. Then dividends per share. And then your own graph. Okay. That's your dividend payout ratio. What are we trying to assess there? We're trying to see how much of the earnings that's available to were actually paid out in dividends. Okay, the higher that is, the higher that dividend payout ratio is, the more attractive. Because once again, want to receive as much money as possible. Okay, I think this is the last slide. Okay, yes. Price to book ratio. Price to book ratio. Here, we're saying, what is the price on the market? So you guys can see the formula. What is the price on the market? In other words, how much you have to pay for each apple of fish? $300. But when we look into the business on the financials, what is the actual value of an apple fish via the financials? Okay? So we're saying the price divided by the actual book price. Alright? And that's how we get the price to book. Price to book ratio or price to book value. Okay? And what we're basically doing is we're comparing how much people are willing to pay for each year, market price, versus how much this thing is actually worth. If this thing is greater than 1, then it shows you that people are willing to pay more than the thing is actually worth. The higher it is, the better. Yes. Sorry? Because they're not that it's different types. And that's what I'm talking about. You are allowed to come to the annual general meeting, and then you see all the events and financial government events, how the company is doing, the direction in which going. And I don't necessarily come to the board meeting every 6 months or whatever. It's relevant what I'm doing. This is the last slide. And all that we're saying here, ladies and gentlemen, you can actually begin to pack up, unless I haven't gotten your name. I haven't marked you off the register. All that this slide is telling you is that ratios are very great. They're very good, but they don't tell the full story. For instance, remember we gave the illustration that initially last year or the year before, you were selling inventory 10 times in a year, but this last year you only sold 5 times. Now somebody might say the business is going down or the business is failing to make sales. But how is the business supposed to make sales when everybody is in lockdown? It makes sense. So your ratios are never going to tell you, there was a lockdown in serial trade level 5 and what. Okay? So that's why we say ratios are great, but what's important to recognize is that they don't tell the full story. And if you now understand that, hey, the business obviously can operate as it usually does because of lockdown, then you know that actually it's still a solid business. It's still worth it investing in, because obviously we will at some point come out of this whole situation. It makes sense. So that's all that we're communicating here, so that you know that don't just fully rely on the ratio alone. Actually, start to get more information. Are there any questions? Okay. All right. That is it, ladies and gentlemen. Do enjoy the weekend, and I will see you next week online.